Students, we will now be dealing with the completion of the audit and the processes that need to go into this completion. This is lecture 1. As you know, the audit process is broken down into 4 stages or 4 steps. We are now on the last stage of the audit, or step 4, which is the completion of the audit. The study material that you will need to use for this topic includes your textbook, any class notes, your question bank, as well as any consultation that you may need with the lecturers. The outcomes of this topic is that you understand the 7 stages within the completion of the audit and be able to apply these stages to a practical scenario. So the completion of the audit can be broken down into the following 7 stages. Stage 1 is the sufficiency and appropriateness of audit evidence. Then we move on to the evaluation of misstatements. We look at the overall review of financial information. We determine whether liabilities exceed your assets. Stage 5 is then post-reporting period events. Stage 6, concluding and reporting, and the last stage, stage 7, is your post-audit review. We will now have a look at the first stage in the completion of your audit, which is the sufficiency and appropriateness of audit evidence. So stage 1 is where we assess the sufficiency and appropriateness of audit evidence. When it comes to the sufficiency, we look at the quantity of audit evidence that has been gathered. And this in turn is affected by what risks were assessed and what your audit quality is. When we look at the appropriateness of your audit quality, here we focus more on the quality of evidence that was gathered. And the quality of your audit evidence is affected by the relevance of that evidence as well as the reliability. Reliability in turn also depends on what the nature of your evidence was, whether it was perhaps oral evidence or written evidence, and also what the source of that audit evidence was. Was it evidence that was obtained externally or internally? And the relevant standard that you need to refer to in this instance is ISA 500, which deals with audit evidence. Another standard that you can also consider within stage 1 is ISA 230, which deals with audit documentation. Now, your audit documentation is evidenced in your working papers, the different working papers that you use on your audit file. All right, so the information that is presented there needs to be sufficient, cross-reference to where else on the audit file it has been used, and also very important, the review of those working papers need to be documented. Remember, the ultimate responsibility of your audit lies with the audit partner, but it can go, your audit work can go through various stages of review, and it's very important that everyone that has prepared audit documentation and reviewed audit documentation has evidenced the fact that they have done the preparation or the review on your audit file. There are certain representations or confirmations that support your audit evidence, and here are some examples of these confirmations. You could have an attorney's letter to confirm whether or not there are any outstanding cases on your client, and that is guided by ISA 505. Every audit file usually has a bank confirmation letter, and this confirms your bank balances and any other information relating to your bank accounts, also guided by ISA 505. You could have other external confirmations, for example, external debtors balance confirmations or loan balances. These are also guided by ISA 505. And then, of course, you have your management representation letter, which is issued for every single audit, and that is guided by ISA 580. Moving on to stage 2, which is the evaluation of misstatements. So the guidance available for the evaluation of misstatements is ISA 450, which is the standard for evaluation of misstatements identified during the audit. Now, the first step here is you need to determine what your final materiality is. All right, so you base your final materiality on your final trial balance or your final figures. Okay, so it's a revision of your planning materiality based on actual financial results. Remember that it can only decrease your planning materiality, which might mean that you need to perform more work, but it cannot increase your planning materiality. Things that you need to consider when you are evaluating misstatements is that there might be provisions coming up, and also that you may need to now disclose certain contingent liabilities or any other contingencies that do come into play. Any audit differences that may come up in this stage is the difference between your audit evidence. Okay, so your audit evidence that was determined by your auditor and your financial statements which have been drawn up by management. And the misstatements coming from these audit differences can be one of three types of misstatements. It can be either a factual misstatement, can be a judgmental misstatement, or it can be a projected misstatement. You use your final materiality figure to evaluate these audit differences. And this is where you then complete a schedule of misstatements, or as it's also commonly known, a schedule of overs and unders. Each misstatement is assessed individually, and then after having completed your schedule, you have to evaluate the total as well. So assess them individually and assess them at the total level as well. For each misstatement, you also need to take into consideration what are any qualitative factors that you may need to consider, and also what are the quantitative factors to consider. When you have prior year misstatements, make sure that those that need to be carried forward into your current year are actually carried forward. Now, your audit differences can be either material or not material. We'll have a look at both scenarios. If the difference is material, management can choose either to adjust your difference or not adjust. If they do adjust a material difference, your audit opinion will be an unqualified audit report. If they decide not to adjust a material difference, you may need to modify your audit report. Okay, so where an audit difference is not material, we need to have a look at the different effects that it could have. If we're looking at an individual audit difference, okay, and it has been adjusted for, then you will issue an unqualified audit report. If it is not adjusted for, you may need to then issue a modified audit report. If the cumulative effect of your audit differences that are not material is still not material, then there will be no impact on the audit report. However, if the cumulative effect of your audit differences that are not material, if it now actually is material, if the cumulative effect is material, if it is not adjusted, you might need to issue a modified audit report. However, if they are adjusted by management, you are free then to issue an unqualified audit report. Information could still come up at the end of your audit process that could affect the fair presentation of your financial statements. And this information can come about through a search for unrecorded liabilities or a search for related party transactions. If anything comes out of from these searches, just be aware that the information coming out could then affect the fair presentation of your financial statements, and certain adjustments might need to be made. We'll now move on to stage 3, of the completion of the audit, which is the overall review of financial information. The guidance available to you in terms of the overall review of financial information is ISA 520, which is analytical procedures. So here you'll use your draft financial statement as a basis to perform these analytical procedures. And these we call your final analytical procedures. It's basically a comparison of your year-to-year figures, and here you need to consider has the information been presented in your financial statements? Is that information being fairly presented? The next step is step 4, which is where we determine if your liabilities exceed your assets. If the entity is still trading while the fair value of its liabilities exceed the fair value of its assets, there are two things that you need to take into consideration. First of all, you need to consider going concern and the effect that it will have on your audit opinion. The second thing that you need to consider is that by continuing this practice, it may be indicative of a reportable irregularity that needs to be reported to the auditing regulator in terms of Section 45 of the Auditing Professions Act. The standard available to use as guidance when it comes to going concern is ISA 570. Now, going concern assumes that the company will continue trading for the foreseeable future, and in this instance, the foreseeable future is 1 year after the reporting date. Now, management has a certain responsibility when it comes to going concern, and the first thing there that they need to consider is whether the going concern is actually appropriate. If they find that going concern is not appropriate, then they need to prepare the financial statements on the liquidation basis. The auditor also has a certain responsibility when it comes to going concern, and that is that they need to consider whether there is any uncertainty that exists when it comes to the company's ability to trade for the foreseeable future, or in other words, the company's going concern. Now, as I said earlier, the auditor has a responsibility to assess the applicability of going concern. And ISA 570 does give some guidance in terms of going concern indicators that the auditor can consider. The first of that is financial indicators. Is the company making profits or losses? Are the liabilities exceeding its assets? That sort of thing. Then there are also operating indicators. Did anything happen to the company that could have affected its operations, and then any other indicators that would be applicable in this case. In a group scenario, the auditor can also have a look at whether or not there are subordination agreements in place. So in other words, if a subsidiary may be having going concern issues, then there might be a subordination agreement where the parent company then agrees to step in and assist this subsidiary if there are going concern issues. So subordination agreements is also something that the auditor can assess and have a look at in assessing whether the going concern basis is applicable. Going concern also has an impact on the type of audit report that the auditor will issue. Now, there are different outcomes here that you can consider. So, if the auditor has determined that the going concern is appropriate, right, then the auditor would most likely issue an unqualified audit report or audit opinion. If there is an uncertainty that exists, the next question that the auditor needs to ask is, has this uncertainty been disclosed in the financial statements? If the answer is yes, then the auditor would most likely issue an unqualified audit report, okay? And then if that uncertainty is material, the auditor would then just include a paragraph describing that material uncertainty. If the uncertainty has not been disclosed in the financial statements, the auditor then is most likely to issue a qualified or modified audit report. If the uncertainty is material, the auditor would issue a qualified audit opinion with the facts under a basis for qualification paragraph. However, if that uncertainty is pervasive, the auditor would in that instance issue an adverse audit opinion with an explanation under a paragraph then headed basis for adverse opinion. If multiple uncertainties exist, the auditor would then most likely issue a qualified or modified audit report with a disclaimer of opinion paragraph. We now move on to stage 5, and this stage then deals with post-reporting period events. Post-reporting period events are also known as subsequent events, and the standard that is available to you to provide some guidance is ISA 560. Now a year has got different points in a timeline. If you put it on a timeline, as can be seen on the slide. So from the start of the year to your year end is what is known as your reporting period. So subsequent to your year end, you've got the audit report date, you've got the date on which financial statements are issued, and you've got the period after financial statements has been issued. So from year end up until the period after your financial statements have been issued is what is known as the period after your reporting date. Now events could take place after your reporting date that could either force you to adjust your financial statements. These are adjusting events. Or you could just have to disclose these events, and these are known as non-adjusting events. From your year end up until your audit report date is an important period. In this period, the auditor should perform procedures to obtain evidence that all the events up to the date of your auditor's report which require adjustment or disclosure in your financial statements are dealt with appropriately in your financial statements. Now, in the period between your audit report date and the date when your financial statements have been issued, management has a responsibility to inform the auditor of facts which may affect the financial statements. So if the auditor becomes aware of facts that may materially affect the financial statements, there are two different scenarios that can play out here. If management decides to change the financial statements, the auditor needs to perform an audit on the revised financial statements and issue a new audit report with a date no earlier than the revised financial statements. If management does not change the financial statements, there are three scenarios that come into play here. If the audit report has not been issued, the auditor still has a chance to qualify that audit report. If the audit report has been issued, the auditor needs to inform management not to make that audit report available to any third parties. If the audit report has already been released, the auditor needs to take reasonable steps to limit the reliance on that audit report. Now, in the period from when the financial statements have been issued, and then for the period after those financial statements have been issued, if the auditor becomes aware of facts that may materially affect the financial statement, there are two scenarios that can play out. If management decides to change the financial statements, they need to perform an audit on the revised financial statements and then issue a new audit report. The date of that new audit report cannot be earlier than the revised financial statements, and it has to contain an emphasis of matter paragraph. If management does not change the financial statements, the auditor has a responsibility then to inform management that they are going to take certain actions. And these steps are there to limit the reliance of third parties on that audit report. We've come to the end of lecture 1 on this topic, students. So the last two stages, which is concluding and reporting and the post-audit review, will be dealt with in lecture 2.